Good morning, everyone. This is Ben Ryan, and welcome to the Hedgeye Morning Macro Call for Friday, November 14th, 2014. Before I hand the call over to Keith, I'll briefly touch on our asset allocation, which is unchanged day over day. We're currently sitting at 68% cash, 28% fixed income, 4% foreign currency. We have no allocation to international equities, U.S. equities, or commodities. With that, take it away, Keith.
Thanks, Ben, and good morning. Those are net asset allocations. So again, if you're running a hedge fund, you're running net exposure of 0 in equities, and you're long, explicitly long, the long bond and cash, etc. Now, today's top 3 things in my notebook. Number 1 would be the Japanese yen. Number 2 would be the Kospi in South Korea. And then number 3 would be the Russell 2000. Now, first on the yen, what really has mattered for the last couple weeks, 2 markets and beta and the yield chase and everything that is carry trading associated with the central planning has to do with the Japanese did. So again, most people didn't have that as a catalyst, but who's keeping track? At the end of the day, now we have to look at the catalyst. So again, look at the yen for what it is. It's actually down another 50 basis points this morning versus the dollar, but it is banging up against our first line of what we call immediate term trade resistance, which is 116.51. Now, that's interesting if only because of the flow-through trade to things like oil. Now, again, if the yen gets overbought, oil can get immediate term oversold in that type of a setup. We're looking at an oversold signal in WTI of around 73. So while we do not like oil, that does not mean that oil cannot bounce. In fact, some of the best bounces are in the most bearish things. That's what bear markets do. They bounce. Again, so look at that for what it is. Point number 2, Dr. Kospi. Now, one of my favorite competitors used to say that Dr. Kospi is the leading indicator for global growth. And then the old Dr. Kospi started to break down. So he stopped talking about it as a leading indicator for global growth because he's bullish on global growth. And global growth is slowing. Just FYI, last night, despite or in spite or, whatever, respite of the Nikkei has been going straight up. It's up 21% basically in a straight line. A lot of Asian markets, particularly emerging Asian markets, and even the Kospi itself are going down. So look at that divergence overnight. The Kospi was down 90 basis points on the session, down 3.2% for the year to date. Dr. Kospi is ill. The third point would be the Russell 2000. Now, a lot of people continue to bandy about the idea that the Russell is a long, after never calling it a short. But again, if you look at the Russell for what it is, it's still obviously down 3% from its all-time bubble high, which was established on July the 7th, where we told you to get long volatility and short the Russell. So again, yesterday's move, a down 1% move in the Russell intraday, mattered. Why? Because you banged the top end of the range on the immediate term, but the intermediate term trend line of resistance for the Russell is 1187. So again, it's still bearish trend, it still has a lot of downside, and it still is a liquidity trap. So again, no support on the Russell to 1138, and then after that, no support to 1005. 1005. And those are your top 3 things. Now, because we're on the morning show, I'll just give you around the world risk ranges again. When we think about levels, we don't think about the moving monkeys, single factor, point and click, simple moving averages. What we think about is price, volume, volatility on a composite signal. So again, understanding what's going on away from just price, which a lot of people tend to chase at bubble highs. It happened in 2000, it happened in 2007, and if you look on Twitter, it's happening right there, here and now. So again, look at it for what it is, and then you start to dig underneath the hood and you see that the S&P 500 has very little upside versus downside, so that's point number 1. The risk range right now is 2011 to 2049. Obviously, it closed at 2039, so you have 10 points of upside and a lot more on the downside. The downside versus the upside today is 3-1. So again, I like to go with where the odds are, and I like to sell at the top end of the range and buy the bottom end of the range. Now, the Russell is where we want to express this more specifically. I've had this on throughout the year. We like the Russell on the short side. Actually, haven't put the S&P 500 on the short side yet, but if I get 2049, I will indeed, sir. Now, again, looking at the Russell's downside, I already gave you the downside of the risk range. It's 1138, and upside resistance is 1137. Now, if you look at the VIX now, which is a good leading indicator for what's happening underneath the hood from a volatility perspective, implied volatility continues to rise as volume decelerates on the up move. So let me say that again. Implied volatility from a trending perspective continues to rise. It would have to break like the low 11 level on the VIX to change that. So that doesn't look like it's going to happen anytime soon. Volume yesterday, and again, a lot of people are like, Well, volume's been down the whole time. It's like they're totally missing the point as usual. Again, look at volume on up days versus volume on down days. Volume on up day, which was yesterday, was down. Total U.S. equity market volume, including dark pool, was down 10% versus the 1 month average and down 28% versus the year-to-date average. So we're getting a liquidity trap in this market. It's almost identical to the liquidity trap that we had developing at the end of September. And very few people wanted to sell that liquidity trap, and even less want to sell it at this point. It's called CYA, and I'm not going to tell you what that is with your C and your Y, but if you look at the backside of your A, you want to be covering that. Most people do. They get bearish at bottoms and they get bullish at tops. You're not going to get that from us, and at a bare minimum, that's where my fake teeth are differentiated. So again, look at that for what it is. Advanced decline line yesterday, if you're keeping score, again, if you keep going underneath the hood, you keep getting more scared. Underneath the hood, look at something like market breadth. So again, advancers versus decliners. On the up day, there were 34% of stocks were advancing, 62% were declining. That's nasty breadth. That's with a DTH, not what's coming out of my mouth. So again, that's nasty. It's just nasty. I don't know what else you'd say about that. If a bull isn't paying attention, gets up at 8:30 in the morning, they don't have to worry about any of these things because the Dow is up. Looking at the energy yesterday, obviously that was a certified train wreck. Again, if you're in sync with us on deflation, it's a lot more important than looking at the Dow Jones. Please do not navel gaze at that or people with toupees. That is what it is. Down 1.3% were energy stocks yesterday. Energy itself was getting completely tattooed. And it was a uniform thing. Natural gas, which incidentally didn't have the polar vortex, was down 5% yesterday. WTI was down 4% yesterday. If you're long some of these terrible looking MLP stocks, are down a lot more than that. So again, there's a lot to do on the long and the short side. Please don't be navel gazing at the Dow Jones Industrial Index. Looking at Asia overnight, as I pointed out, you had a disconnect between what's going on in central planning terms, which is of course what's going on in the Nikkei, and then what's going on in Kospi terms. Actually, China was down too last night, down for the second day in a row. The Chinese stock market was, and that's actually been one of the better performing markets in the world for the year to date, but that is what it is. Europe across the board. As a friendly reminder, the growth data continues to suck. I think I saw some Bloomberg headlines this morning saying, well, German GDP inched ahead and Greece came out of the recession or something like this. I mean, if you're seriously doing macro tourism, I mean, you just cannot read these headlines for what they are. The reality is that the rate of change in European growth continues to slow. Italy looks horrendous. I mean, Italy at this point is in a recession. GDP in Italy this morning was down 0.4% year over year. That would qualify, even in Keynesian economic terms, as a recession. So again, what's going on in Europe? You could see it in the equity markets. They're making lower highs. And what you could see it in the sovereign debt markets, i.e. the markets that people went to in Japan, they're going to here when growth slows. They act quite well. So people, if you're long German bunds and you're short Italian stocks, big golf clap. That's a great position. It's the same position as we have in the U.S., which is we're bearish on growth, so we're long the long bond, we're long long-term treasuries, and we're short the Russell. Look at the performance spread between those two things. It's only 1,700 basis points wide. So again, that's what you do when global growth slows and interest rates are falling. You go park your cash in a treasury type security and you make money and you like it. Cool. Looking at the rest of the world, by the way, it is slowing as well. Russia continues to crash, down another, I don't know, whatever this morning. It's down 28% for the year to date. I'm sure nothing wrong is going to go on there. Putin this morning was saying that he's preparing for a catastrophic oil slump. Take his word for it. He blamed the West. Again, a lot of people are going to blame a lot of people when energy does what it does. Deflation is not something that the world has been set up to trade for the last 5 years. Deflation, very nasty, very gnarly. If you own any energy bonds, stocks, or countries, God forbid you're long the Putin, I mean, these things do not act well, okay? Brazil, here's another one. Yesterday, down 2.1%. I'm sure that was all over the New Jersey television broadcast of what's going on in globally interconnected risk. That is a mouthful, but the reality is are you kidding me? Of the top 7 economies in the world, growth is collapsing. Brazil is in a recession. That's the 7th largest economy in the world. Russia's number 6. You want to keep going? You want to go to Japan? They basically told you that they could just actually go and seep into the watery part of what was that island. I mean, economically speaking, by the time you get to China and the U.S., which are the top 2 countries in the world, growth is so anemic to not even existing relative to where people have been throughout the year with this narrative of bullishness that it's almost like embarrassing to kind of call it out one by one. So I'll stop with that. Looking at commodities across the board, deflation is pervasive. Again, CRB index, which is 19 commodity components, that was down 1.6% yesterday. That continues to break down. Again, inflation expectations now look like deflation. So you can look at CRB index, you can look at break evens, you can look at tips, you can look at oil, you can look at anything stock bonds that is related to oil. It's called deflation. Cool. Gold, that means you don't buy gold, by the way. No support for gold to 1134. Again, we took that off in real-time alerts for good reason. And again, we would just look at the risk range for what it is. Gold's trading right in the middle of its risk range with a downward bias. Now, looking at the 10-year bond yield, just to hit on that before I take questions, because again, you know I like the long bond. We're not going to make any apologies for it. The TLT in total return terms is up 18%, I think, for the year to date. And again, where's the next gain in the 10-year? It's that you see the 10-year bond yield go back to 2.2%. So the immediate term support line for the 10-year is 2.29, but you could easily get back to 2.2 and then test 2.0. And at 2.0, we're just going to be happier. I don't know what else you'd say. I mean, I don't know why so many people are so agitated about this year. I guess it's just because they've had a bad year. But again, if you look at what's actually happened in the market, the lowest volatility and largest asset allocation position that you should have taken is in the long bond. And we'd reiterate that again this morning for a lot of the reasons that I just ranted through. So maybe a good time to stop ranting, Mr. Ryan, and take some questions.
Sounds good, Keith. We got a question that came in from a relatively new RTA subscriber. How was the decision made to manage losses when the signals are not working? So if you sell something at the top end of the risk range or short something, and it moves moves higher, like what's the next process point?
So RTA, for those of you that don't know, is called real-time alerts, and it's a signal that we send out throughout the day. We'll send out signals in currencies, bonds, stocks, long and short side. Actually, over the years, we've had 55% of the calls I think we've made or sent out 2,500 signals have been sell calls. Now, typically people don't make sell calls, and it's really tough to make sell calls in a rising equity market, for example. We haven't been shy to do that this year, and I think we've been relatively successful doing it. That's not to say relative is always good. Now, the question is pointed specifically at when we send out a sell signal and the thing starts going against us. Okay, so that's called being wrong. So the first thing I do is I get upset about it because I don't like being wrong. But the second thing I do is I look at the upside of the range relative to where I put it on. So a good example of this is Alibaba. Like Alibaba, I put it on the short side. I signaled sell it at 103. I forget what the price is, but it's out there. It's time stamped. It's like 103 or 104. And it went immediately down the next day. I didn't cover that signal. That's what I should have did. That was my second mistake. And then the stock starts gapping up again. They did the singles thing. And I'm like, oh my God, I'm going to get run over in this. So on the first pullback, again, I use a 12% stop loss. But again, on the first pullback, I got to cover it. I got to say, look, we had this wrong. This thing is a mania. That's the whole thing about a bubble, is that a bubble keeps getting bubblier. And I'm just going to get it out of the way. So what I like to do is try to stop ourselves out of those and let things, again, you can't let everything run, on the short side, obviously. This is a market that hasn't gone down for, 19 days? So again, what I'm trying to do is really yank out some alpha on the short side and cover some of these things whenever I get the chance. But something like Alibaba, I didn't, so I had to cover the mistake and take a loss.
Yeah, great. That's good color. It's perfectly clear. What are Hedgeye's favorite early cycle consumption stocks? And basically, should you be in these stocks before the flush, or so it's called, or is it are you going to be able? Are you going to have the liquidity? Are you going to be able to?
Well, it's a good question.
Move into these stocks when everyone else wants.
So if you follow our call and you don't just again, this down navel gazing thing or the market's up, it's like, come on, McFly, let's get with it a little bit here. So if you were to only look at the world in early cycle stocks versus late cycle stocks, throughout the year we said short early cycle stocks because the cycle is slowing. So again, at the beginning of the year we said short casual dining restaurant companies, casinos, retailers. A lot of these stocks have had a lot of issue. Housing, these are all early cycle stocks. So as we go through, early cycle slowdown becomes a mid to late cycle slowdown. You're seeing the later cycle things like inflation and unemployment get less good. In fact, inflation is becoming deflation. So as we get through that, the next move is to actually go buy the early cycle stuff. So people are constantly asking me, and this is kind of the rub, people don't really want to skip through to anything other than upside in things. So in other words, they only want things that are going to go up. They're not talking about things that can still crash. So what I'd say is that the early cycle stuff still needs to actually flush, like you said in the question. You need to see that stuff flush like it did in early October. If you bought them in early October and you sold them in July so that you could buy them in early October, like congratulations, fantastic call. I didn't make that call down there. I thought that we could go a lot lower. I still do. But that's what I would do. If you look at our playbook, all the stuff that I haven't liked throughout the year would be the stuff that I like first on the long side. But we're not there yet. And on the same token, I would get bearish on bonds at that same point. It's still the same process. You go in order. You don't flip around. You don't ask some dude on TV what you should do next. You stay with the playbook and you execute the process.
Right. When do equities finally top and sell off if we have quad 4 deflation?
Where do they top off?
Where and when?
Well, I mean, equities, so let's broaden our horizons and look beyond the moving monkeys and the Dow or the S&P. Equities are global. Equities globally act like death with the exception of the Dow. So we have currently, I would say that if you're short global equities, which would include fully loaded emerging markets, anything in Europe, and actually components of the U.S. stock market, you can see the deflation playing out. Now, if all you do is come in every day and quote how many points the Dow is up, you're probably thinking things don't look too bad altogether. That's called navel gazing. So again, I'd say that it's already playing out. When you wake up to the Dow or the S&P 500 going down a lot, the market's going to decide. If you have a super secret message on when that happens, let's say it's next Tuesday, then give me a buzz. Maybe you're going to give me the right call. I don't know, but I haven't hit the button yet. I mean, the S&P 500, what I'd like to see that do is tap the top end of the range, and I'll hit the button myself, and we'll see if I'm right on that. But again, the economic call and the correlated market call from global macro markets to anything that's ticking, currencies to commodities and back again's already signaling, folks. You don't need somebody to give you a super secret call on that.
Great. Surprise question here on oil. What happens if retail sales miss? Wall Street is just talking about the tailwind for the consumer here.
Well, I mean, retail sales have been missing. I mean, don't forget that a month ago today, and again, maybe people want to be intellectually honest about it, maybe they don't. But if you bought the Russell 2000 on July the 7th when the VIX was at 10, that was about the dumbest mistake you could have made in 7 years. Again, and I don't mind calling people out on that because I get called out all the time too. I mean, it's fine to make mistakes, but that was a pretty bad mistake. So, you're here a month ago today, and the Russell 2000 is down 15% from there. In other words, you got to be up almost 20% to break even. And people are now sitting there looking at this thing, saying, well, what do I do with that? What do I do with that? It's like you go back and do what you did. I mean, hopefully you did it. If you didn't do it, you can't be telling me that you didn't do it, but you're still long it for the wrong reasons. I mean, so that's kind of like where I wash out on that. What was the question, by the way, again? Did I answer it, or was that what it was specifically?
Yeah.
Yeah.
No, it's
I mean, is
there a real headwind for the consumer right now?
Yeah. So the Russell 2000 is like the manifestation of U.S. domestic revenues. I mean, the Russell 2000. That's the point. The gas price isn't going to save everything. 80% of the Russell's revenues are in the U.S. And if you look at the most early cycle components of the Russell, which include regional banks, housing stocks, consumer discretionary stocks, all these stocks throughout the year have been telling you that the consumer is slowing, and so has the consumer data. So irrespective of what this morning's retail sales number did, it only went up because it was so bad last month. I mean, at the end of the day, what you see is a rate of change turn in consumer spending and retail sales. So again, that's the problem. At the end of the cycle, that's what happens. And the next thing that's going to happen is that unemployment and jobless claims are going to start to rise. That's the end of the cycle stuff that starts to go bad next. That's when the Fed gets more dovish. So again, I think the bond markets had this right. I think if you look at consumer discretionary stocks, they're the worst performing subsector in the entire equity market. If you look at the top 9 S&P sectors, that's why they're underperforming, because the consumer's not healthy. Maybe Walmart's stock can go up, but that doesn't mean that the consumer made it go up. It's just that people are chasing stocks. Walmart yesterday had a down 1% traffic number, which last I checked, if everyone were hopped up on gas prices, jetting themselves to Walmart, well, traffic was down 1%. So how does that figure? And ticket was up. Ticket was up 1.2%. Why was ticket up if gas prices are so low? Well, because there's other things in consumers' baskets other than sticking a gasoline hose down their throat. There's called food. There's called healthcare. These were the parts of the basket that actually Walmart said were inflating. And then if you look at the biggest part of the basket in the real world, it's called rent. A third of what the median consumer's spending basket is rent. And we're currently hitting the all-time highs in U.S. rent. So there's plenty of headwinds. That's why 2/3 of the country's in a recession. And the last third of it, or the last third of it on Wall Street, doesn't see that because that's not them.
All right. Last question here. Yale or Harvard in hockey this weekend?
Woo! Yale or Harvard? I mean, the contrarian call would be to go with Harvard because Harvard's only lost the last 3. So, I mean, I still got to go with Yale.
Wow. That was predictable. Okay, thanks everyone for tuning in today, and we'll catch you back here Monday, same time.